There are some stocks that the market just counts out and they continue to perform quarter after quarter. And one of the companies that's doing that is Crocs. Shares are up 26.5% over the last 6 months. The company just reported a great quarter for the fourth quarter of 2023, and expectations for 2024 is another pretty solid year. Shares are trading for just a little over 9 times earnings. Price to free cash flow is a little less than 9x. And I think there's a ton to love about this stock. Yes, there's a little bit of debt on the balance sheet. Yes, the Hey Dude brand is struggling, but it seems like that business should be turning around in 2024. And if the core Crocs business continues to grow steadily and continues to churn out cash quarter after quarter, I think this is a stock that can do extremely well over the next few years. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the recent quarterly report because this is what really surprised investors and sent shares higher last week. This is just the high level numbers, but I want to highlight a few things here. Revenue of $960 million, up just 1.6% from a year ago. The Crocs brand is actually doing really well. It's Hey Dude, which was down pretty sharply. I'm going to get to that when we get to the presentation in just a second. Gross margin, 55.3%. This is what I think investors really need to understand, is that this is a very high gross margin shoe or apparel company. You don't typically see these kinds of companies having a gross margin over 50%, and Crocs is consistently over 50%. And you can see that earnings per share nearly doubled to $4.16. During the quarter, $277 million of debt was repaid. So this is reducing the leverage that most of that was taken out to do the Hey Dude acquisition. They got down to their goal of 1.5x net leverage, and so they're at 1.3 right now. And they repurchased 300,000 shares for $25 million at $86.34 per share. As I'm recording, shares are over $118 per share, so that looks like a pretty good buyback right now. Here's the Q4 highlights from the presentation. You can see the revenue up about 2%. Crocs brand drove most of that, up 10%. I'll get to the Hey Dude numbers in just a second, but they were down almost 20%. There's strength in North America. This is not really the growth market, but where you're going to see a lot of growth is in Asia. Just the fact that Crocs is staying steady in North America, I think, is a solid sign, and pretty solid profitability numbers that you can see at the bottom here. This is the Crocs brand versus guidance. Guidance for the quarter was 4 to 7% growth, and they did 10%. So better than expected there, better than expected holiday. Promotional activity was down versus 2022, so maybe a little bit of a stronger economy. And inventory was down. This is something that we saw across the board. So that gives Crocs a little bit more cash flow when you're not putting cash into inventory. The Hey Dude brand is actually where there's a lot of weakness. And there's a number of strategic changes that they're going through, changing their distribution, pushing to more direct to consumer. You can see that 4% of revenues in the recent quarter was direct to consumer, but you have 19% drop in revenue, and guidance was for 20 to 25% drop in revenue. So better than expected, but still not good. And inventory was down 38% versus the prior year. So consistent with what we saw for the Crocs brand. I wanted to just touch on this capital allocation because this is something I think is critical if you're looking at Crocs as an investment. When the Hey Dude acquisition went through, net leverage, which is the company's debt minus cash divided by EBITDA, which is a proxy for cash flow coming from the business, that was 2.1x. Management wanted to get down to 1 to 1.5 times. In the most recent quarter, they were 1.3x. So they've made a lot of progress on that. I would like to see them continue reducing debt, but they're also buying back stock, have $875 million remaining on that authorization. So I think that's something we'll continue to see them do in the near future. And when it comes to guidance, they're expecting basically continued strength, continued performance along the lines of what we've seen. For the first quarter, revenue is going to be relatively flat, might be down a little bit. But for the full year, expecting 3 to 5% growth. That is going to be driven again by Crocs, but you can see here the Hey Dude brand is going to be flat to up slightly. That's what they're expecting for the quarter. So that's where these changes to their distribution model, going to more outlets, expecting to basically stabilize that business. Gross margins expected to be strong in an operating perspective at 25%, and earnings of $12.05 to $12.50 per share. So given the stock price today, trading for less than 10 times what they're expecting for full year 2024 earnings. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the challenges for Crocs has always been, how long is this business going to last? I think this was a product that I even saw as a hype product when it came out, when the company came public, but it's lasted a lot longer than I thought. They've expanded into more and more products. And I think at the end of the day, this is a much stickier business than it was 5 or 10 years ago. They've gone from their traditional Crocs clog, they've gotten into sandals, all kinds of new models over the past year, add in the Hey Dude brand. That's struggled obviously a little bit, but it diversifies the business. So when you get to a company that's trading for 9, 10 times earnings and you have a diverse product lineup, that's a much stronger position to be in than Crocs was just a few years ago. So I think that's a really strong thing for Crocs. And frankly, with their international growth, the amount of growth that they've had, particularly in Asia, but also other parts of the world, there does seem to at least be single-digit growth for the business overall for the foreseeable future. North America may not be a huge growth market, but again, this is just kind of a cash cow, and you want Crocs to generate a bunch of cash, buy back stock, pay down dividends, reduce that debt load, just continue returning cash to shareholders. And given where shares are trading, that can be enough for the company. The upside is if there is significant more growth, or if the Hey Dude brand does make a significant turnaround. It looks like the first quarter is going to be another down quarter, but then the comparables get a little bit better for Hey Dude. So we'll see if that turns around and they're able to show a little bit of growth in the second half of the year, since they're expecting revenue to be flat for the full year and down pretty sharply for the first quarter. That would indicate that the final 3 quarters of the year, they're expecting growth in that Hey Dude brand. We'll see how that plays out. But Crocs has been outperforming their guidance and expectations over the past couple of years and over the past few quarters. So given the relatively low guidance from a revenue growth perspective, I could see this company continuing to outperform. And if it does, I think shares look extremely cheap, especially when you compare it to other shoe and apparel companies, which are typically trading more like 20 to 25 times earnings right now. So Crocs continues to outperform what expectations are from the market. I have fallen into that in the past, but over the past year, I've really changed my tune with Crocs. I've acquired some shares, and it's a stock that I'd be looking to add if we get any sort of pullback in the stock. But right now, shares are getting a little bit of momentum. I mentioned that they are up pretty sharply over the past 6 months, jumped just last week after earnings, and for good reason. Really solid fourth quarter results, decent guidance for 2024. And if the company can continue to outperform the guidance that they're giving to investors, I think this is a stock that could return double digits again over the next year. But what do you think of Crocs stock? Is this a fad? Is the company going to run into a wall eventually? Or is it going to continue being underestimated by investors? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.